Most investors make a fatal mistake. They look at a low P/E ratio, think they found a bargain, and hit the buy button. But months later, they're down 30%. Why? Because the P/E ratio is a trap if you don't know its blind spots. Today, I'm showing you the professional 3-step framework to find the real value of a stock. We are moving from the basic P/E to the growth-adjusted PEG, and finally to the ultimate debt detector, EV/EBITDA. Let's start with the price-to-earnings ratio. It tells you how much you pay for $1 of profit. It's a great starting point, but it has two massive flaws. It completely ignores growth and it completely ignores debt. Imagine buying a car just based on the price tag without checking if the engine works or if there's a massive loan attached to it. That's exactly what you do when you only use P/E. This is where the PEG ratio comes in. It stands for price/earnings to growth. It takes the P/E and divides it by the annual growth rate. This changes everything. Let's look at two giants in 2026, Intel and NVIDIA. Intel has a P/E of around 14. Sounds cheap, right? But with a growth rate of only 2.5%, its PEG ratio is a staggering 5.6. That is incredibly expensive for a stagnating business. Now, look at NVIDIA. A P/E of 42 sounds scary. But because they are growing at 65%, their PEG ratio is only 0.66. The lesson? The expensive stock is actually the bargain because you are buying massive future growth at a discount. But wait. Even the PEG ratio has a weakness. It ignores debt. A company can have great growth and a low PEG, but if it's drowning in interest payments, it's a ticking time bomb. Let's compare two companies with a similar PEG of 1.0, Company A, a legacy airline, and Company B, a software firm. Both look equally attractive on paper. But Company A has $50 billion in debt to maintain its planes. Company B has zero debt and $10 billion in cash. If interest rates rise, Company A's profits will vanish, while Company B stays profitable. To see the truth, pros use EV/EBITDA. Instead of just looking at the stock price, we use enterprise value. This is the market cap plus all the debt, minus the cash. It's the takeover price of the entire business. We then compare it to EBITDA, the raw cash flow before accountants and taxes get involved. A low EV/EBITDA ratio tells you, this company is generating massive cash relative to its total price, including its debt. This is how you find the safest and most profitable investments. Don't just be a PE investor. Use the PEG to find growth and EV/EBITDA to avoid debt-ridden traps. In my next video, I'll show you how to use these metrics to build bull, bear, and base case scenarios so you're prepared for any market condition. Which metric do you find most useful? Let me know in the comments. Like and subscribe for more professional deep dives. See you in the next one.